In this video on the Tax Compliance and Planning exam, we're going to go through the entire blueprint so you know all of the topics included on the exam and what skill level they require. Is it remembering and understanding where you just need to know a specific rule, or is it application or analysis where you need to actually apply the rules that you know? So after we break down all of these representative tasks, you can go through the blueprint, see which topics you know and which topics you need to study a little better. So with that, let's jump in. The first thing to focus on for the TCP exam is the content area allocation. The first section is tax compliance and planning for individuals and personal financial planning. So this is all focused on the individual, 30 to 40%. The next two sections are on entities, entity tax compliance and entity tax planning. Compliance is 30 to 40% and planning is 10 to 20%. Compliance is focused on following the rules for entities, and planning is looking at making decisions about the future for the entities. And lastly, we have property transactions, specifically disposing of assets, which is 10 to 20%. Now, in terms of the skill allocation, 5 to 15% is remembering and understanding, which is simply regurgitating information. Application is 55 to 65%, which is where you need to demonstrate the knowledge of the taxes. And then analysis, which involves a deeper level of applying the knowledge. So the first section is tax compliance and planning for individuals and personal financial planning. So in this first part, we have the individual compliance and tax planning. We're looking at what happens when you receive equity compensation like stock options. You need to recall what goes into the calculation of alternative minimum taxable income, but you just need to remember it. You don't need to actually apply it to a calculation. Then you need to consider how imputed interest affects an individual, or how compensation earned outside the US affects an individual. From there, you focus on the 𝗔𝐶𝐶 tax rules for earning income. Then you need to know, how should I change my decision-making based on changing tax rates? Then we need to know, should I use an FSA plan or should I use an HSA plan? From there, based on a certain scenario, should I itemize my deductions or should I take the standard deduction? Then I want to be able to estimate my tax payments to avoid any penalties. Then I need to calculate my tax savings whenever I donate non-cash property to a charitable organization. The next section is compliance for passive activity and at-risk loss limitations. So it's looking at the limitations based on the kind of income that you have. So the first part looks at calculating the at-risk loss limitation. The next is when you are not materially participating, but you're passively participating. So you need to know how to net together your passive activity gains and your losses. And you need to know how to treat the suspended losses that you can't recognize in a particular year. From there, we focus on gift taxation compliance and planning. So what are the gift tax deductions whenever you give a gift to somebody? How does the unified transfer tax system affect whether or not you pay taxes on gifts or on an estate? And calculate the amount of taxable gifts for federal gift tax purposes. The last section of Area 1 is personal financial planning for individuals. So first, you need to know the advantages and disadvantages of qualified retirement plans. This includes a traditional IRA, Roth IRA, 401k, annuity, and employer-sponsored plans. From there, you need to know about the different risks for different investment options. So what are the risks for equity securities, corporate bonds, and municipal bonds? From there, you need to know about the post-secondary education fund options and how they can benefit your tax situation. Then you need to know about how insurance can help with investment planning. From there, you need to demonstrate an understanding of the implications of legal ownership of an asset and beneficiary designations. This is for estates and their beneficiaries. So this is the personal financial planning for individuals section. Then we move to Area 2, which is entity tax compliance. This focuses on C Corps, S Corps, partnerships. And it's not just focusing on how they recognize gross income or whether something's a separately stated item. It's focusing on the more complicated transactions, such as non-cash contributions and distributions. So first we have net operating loss limitations and capital loss limitations. From there we have the realized and recognized gain whenever you have contribution of non-cash property. Then we need to focus on non-liquidating distributions of non-cash property, and then liquidating distributions. We also need to know how to calculate the company's earnings and profits. And we need to know the different requirements for consolidating the tax returns. From there, we need to know about international tax issues for C Corps. This is mostly just remembering and understanding. So we need to know about the sourcing of income when there's a US corporation that operates overseas. We need to know about the concept of controlled foreign corporations, the concept of permanent establishment, and these various requirements. From there, we move to the S Corp entity tax compliance. So we need to be able to calculate the shareholders' basis. This is going to include contributions of non-cash property, even the assumption of debt. We need to look at how non-liquidating distributions of non-cash property affect basis, and look at how loans affect basis. In this last section on S corporations, we have to calculate the realized and recognized gain on the contribution of non-cash property. We need to see how non-liquidating distributions of non-cash property affect it as well. And we need to know about liquidating distributions. Then we move to partnerships. We first focus on basis of partners' interests. Just like the other sections, this focuses on contributions of non-cash property. It focuses on non-liquidating distributions. It focuses on recourse versus non-recourse debt. And these elements affect the partner's basis. From there, we have the partnership and partner elections, which is where we choose the partnership tax year, for example. Then we continue with partnerships. We need to see the implications of certain transactions between the partner and the partnership, like when services are performed. Then we need to see the impact of the contribution of non-cash property. We need to look at non-liquidating distributions of non-cash property and liquidating distributions. From there, we need to see how we calculate the income whenever there's a change in ownership. From there, we focus on trusts and tax-exempt organizations, which are not tested nearly as much as C Corps, S Corps, and partnerships. But for trusts, we want to know about the types of trusts, such as a simple trust and a complex trust. We also want to know about revocable trusts, and we want to know about how their income is treated. Then for tax-exempt organizations, we want to know the requirements of a 501c3 organization, what could cause it to lose its tax-exempt status, and what unrelated business income is. Then we move to Area 3, which is entity tax planning. First is formation and liquidation of business entities. This is where we need to know the advantages and disadvantages of each type of entity, so that way we can choose the best entity given a specific scenario. Then we need to focus on tax planning for C corporations. So we need to know how we could use a net operating loss or a capital loss carryover for tax savings. We also need to know how we optimize state and local income taxes. Then we need to know about how changing tax rates affect our planning, how we can estimate our tax payments to avoid penalties, and how we can plan for non-cash property contributions and non-cash property distributions. Then we move to tax planning for S corporations. We need to know how to optimize our built-in gains tax. We need to know what happens whenever we terminate an S corporation election. We also need to know how non-cash property contributions and distributions affect the S corp. And we need to know about how we treat the accumulated earnings and profits versus the accumulated adjustments account. From there, we go to tax planning for partnerships. So here we're considering what happens whenever you have non-cash property that has appreciated or depreciated in value. Then we're looking at various types of payments, such as guaranteed payments and non-liquidating distributions. And then from there, we're talking about contribution of non-cash property, non-liquidating distribution of non-cash property, or the sale of the partnership interest. Then we get to the last section, which is property transactions. So this isn't focused on what you do when you buy an asset, how you capitalize it, and it's not focused on how you depreciate the asset. It's focused on what happens when you dispose of an asset. So the first section is going to be on like-kind property exchanges and how we account for them. Next, we're going to know about Section 1231 transactions, Section 1245 property, and Section 1250 property, and how we have to use depreciation recapture for them. Then we're going to learn about Section 1244 small business stock. From there, we want to know how to recognize a gain on an installment sale. And the last part is related party transactions, like when you sell a fixed asset to your sibling. So we're going to recall who related parties are. We're going to calculate the direct and indirect ownership percentages of corporate stock. We're going to calculate the taxpayer's gain or loss from these transactions. And we're going to talk about the concept of imputed interest on related party transactions.